Most people believe mutual funds are the safest and only gateway to wealth creation. But here's the truth. In the past 1 year, 10 mutual funds in India have underperformed badly, losing between 14% to 16% of investors' money. If you had invested 1 lakh rupee, today you'd be left with just 84,000 rupee. But the real story here isn't just about the losses, it's about the lessons. So in this video, let's look at the 10 worst performing mutual funds of 2025 and the powerful investing lessons they teach us. 1. Quant PSU Fund has given negative return of 16.5%. 2. Quant Manufacturing Fund has given negative return of 15.65%. 3. Tata Nifty Realty Index Fund has given negative return of 14.72%. 4. HDFC Nifty Realty Index Fund has given negative return of 14.10%. 5. ICICI Prudential Nifty 200 Momentum 30 Index Fund has given negative return of 14.10%. 6. HDFC Nifty 200 Momentum 30 Index Fund has given negative return of 14.9%. 7. Bandhan Nifty 200 Momentum 30 Index Funds has given negative return of 14.6%. 8. Motilal Oswal Nifty 200 Momentum 30 Index Fund has given negative return of 13.93%. 9. Samco Flexi Cap Fund has given negative return of 13.93%. 10. Quant Consumption Fund has given negative. Let's take a deeper look at why did these funds crash. Exposure to thematic and sector risk. Thematic funds were once hot favorites, built around single sectors like PSU real estate, manufacturing, or consumption. But here's the risk. If that one sector struggles, the entire fund falls. Momentum strategies failed as many of these funds followed a momentum strategy chasing stocks that were already rising. But when market trends reversed, momentum funds were hit the hardest. Cyclical nature of sectors, as performance shift and sectoral rotation often happen in the market. Real estate and manufacturing are cyclical. They shine during growth cycles but crash when economic conditions tighten. Investor trap. Flashy short-term returns often attract beginners. But when the market cools, reality hits hard. And then most beginners sometimes feels market is a fraud. But market reward to those who have the patience. So what can we, everyday investors, learn from this crash? 1. Don't chase hot themes. That's a mistake many beginners make. Today it may look like PSU or real estate is the next big thing. Tomorrow, the cycle changes. 2. Momentum is not magic. Just because a stock is rising doesn't mean it will keep rising forever. 3. Diversification is your shield. Instead of putting all your money into a single sector, spread it across different sectors or use a broad index fund. 4. Think long term. A 1-year fall means nothing if your horizon is 5, 10, or 15 years. In fact, some of these funds could recover strongly later. 5. Stick to your financial goals. Don't get distracted by short-term crashes. If your goal is 10 years away, focus on the journey, not the noise. These 10 funds remind us of something powerful. Even the best-looking investments can fail in the short term. But true wealth is not built in 1 year. It's built over decades, with patience, discipline, and smart choices. So instead of fearing losses, use them as lessons, because every fall in the market is also an opportunity to buy better, to plan smarter, and to grow stronger. Would you still take the risk and invest in thematic funds, or would you rather stay safe with diversified funds? Now tell me, would you invest in any of these funds, or would you avoid them completely? Share your thoughts in the comments. And if you found this helpful, subscribe to Finance for the Street. Together, we'll keep learning how to grow wealth steadily, wisely, and with confidence.